Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I'm a coach with Schwab and delighted that you are here. And today we are going to talk about covered calls. Now, covered calls, I have a bit of a love-hate relationship with. I'm just going to be honest about that. But I have learned to look at this trading tool rather fondly over the years. We're going to look at why that might be and how a trader might consider using this trading tool. So if you're new to the world of options, and I know some of you are here live for the very first time, I want to welcome you. I want to invite you, if you're watching in the archives, we do meet at high noon Eastern every Tuesday, and we're linking arms together to figure this out. You're welcome to join us live. If you have questions, please don't hesitate to type them into the chat. We have the fabulous Ben Watson with us today. He knows this strategy inside and out. And if you want more on an introduction to options and you're in the Orlando area, you may want to get in your car, and we have a workshop going this weekend, and it's 2 full days of Ben. The first day, I believe, is technical analysis. The second day is getting started with options. So be there, be square. We wrap up the year in, I think is it Dallas is the last event of the year? Or no, it's Houston, the following weekend, and then we're done for this year. We kick off the new year in Dallas. So if you've never attended a live event, you may want to consider that. They're pretty awesome. So let's get right down to business. So know that you have a formal invitation from both Ben and I to follow us in the land of X. We're posting content there on a daily basis that we think you'll find helpful and informative. My handle is Barb Armstrong CS, Ben's Ben Watson CS. So please consider joining us there. We're on week 4 of a 12-week series, and it doesn't matter where you pop in, because each and every week I assume that you know very little about options. And you can always go back like Netflix and do some binge watching. You can do some binge learning with this series. So, but know that options carry a high level of risk and aren't suitable for all investors. When we use a covered call, it can limit the upside potential of the underlying stock position, and I'll go into why that is. But if the stock moved up dramatically, you would likely be called out at the strike that you sold it for. And that, the likelihood goes up as the stock price goes up. Then they offer limited downside protection, and we'll talk about that as well. We're using the Paper Money software application on the Thinkorswim desktop platform. And this is a brilliant place to learn and hone your skills, particularly if there's a strategy that's new to you. It's great to be able to practice it multiple times in Paper Money to make sure that you understand what you want to have happen, and to understand not only when to place the trade, but how to manage it once you're in it, both if the trade goes for you or against you. So Paper Money is a really great tool, but one of the nuances or differences is that with a covered call, you can be called out prior to expiration in your live account. That will never happen in Paper Money. Okay. I do not believe we have lost sound. So Jay, I would hit refresh. Ben, could you type that into the chat if he can't hear me? Okay, so what are we doing today? We're talking about all things covered calls, what a covered call is, why a trader might consider using it. We are going to cover the basics of doing a covered call. We're going to go out and place a couple of example trades. Okay, and then we're going to look at, if you really like this strategy and it's appealing to you, where might you want to go to learn more? Okay, so here we go. What does it mean to sell a covered call? Okay, well, when we sell a covered call, we are selling a call. And this indicates, if we're selling a call, it indicates that just let me bring up my drawing tool here, that we own 100 shares of stock. Because when we sell a call, that represents, with the standard contract, 100 shares. Okay, so we're going to look at examples where we own at least 100 shares of stock. And what we're doing is we're creating an obligation. Oh, geez, look at this. I posted something on X today. Yeah, and so that's, I didn't notice it because it was in black. So we've got 100 shares. We're creating an obligation to sell the stock at the strike. And it's at any time, and this is really important, at any time up until the expiration date. Now, if you inherited this stock from your grandmother and you're selling a covered call because you'd like to make a little extra income, and maybe the stock's been going sideways for a while, and all of a sudden it goes up and you're going, but I didn't really want to sell it. Well, yeah, too bad, so sad. If you have sold a call and you get called out, it's gone. And that can create a taxable situation. You'd have to talk to your accountant about that, but you can't say, just kidding, let me give you your money back. You've committed to selling the stock and you can be called out at any time. So if you are sure that under no circumstances do you actually want to sell the stock, then you don't sell a covered call because you're putting yourself in a position where you might have to sell it. Now, there are lots of situations where you might say, here it is. Thank you for shopping in my stock store. I'm quite happy to sell you this stock at this price. And what do we get for selling a covered call? Well, we get a credit. So we are paid for creating that obligation. Okay. So, it's a way to generate income. If a stock is going sideways, so if you have a stock that's been kind of going like this, and we're going to look at one of those, you might say, well, hey, it's kind of up here. I'm going to sell a call here because my expectation is likely to consider going, it's likely to continue going sideways. And then, you buy it back when it gets here, and then you sell another one when it comes up here, and you buy it back when it comes down here, et cetera, et cetera. So I call that wash, rinse, repeat. The other thing, and this is what we're going to talk about today, let's say you bought a stock and a couple of things could have happened. Let's say 3 years ago, you bought NVIDIA at $200 a share. And, it's now done a 10-for-1 split, and you've made an enormous amount of money on it, but it's now half your portfolio. And so you might say, well, I really should sell at least 100 shares of this stock because to rebalance my portfolio. And why not have somebody pay me for the privilege of buying my stock from me? And so that's another reason we might do it. We might want to sell the stock and say, hey, wouldn't it be nice if somebody paid me to buy stock I wanted to sell anyway? Or maybe you have a stock that's been kind of going nowhere and you'd rather invest the money in something that is moving more to the upside. I mean, the market's been really bullish, and we're going to look at a couple of those examples. But overall, your outlook is either bullish or you have a stock that's sideways, and you may want to keep it because maybe you bought it when it was trading back here and it's now come up and it's going sideways. Or maybe it pays a nice dividend. Maybe it pays a 5% dividend. Now, dividends aren't guaranteed to be continued, but maybe it's currently paying a 5% dividend, and you're thinking that's kind of cool. And this is another one of the differences between paper money and your live account, is that in your live account, dividends are actually paid. In paper money, they're not. Another thing to consider, though, is that you are capping your reward at the strike price. And in our trading a smaller account, we, have one example, and I'll talk about it in more detail last week, where we bought it and we said, hey, if we're called out, we're totally cool with it. And it has already gone through that strike. And so we have put a cap on how much we can make. But next week, we're going to talk about what we did actually in that class, which was buying the stock and selling a covered call at the same time, which is called a buy-write covered call, where you're buying the stock and writing a covered call at the same time. So I'll cover that one in more detail then. Okay. So different ways to think about it. And when I started thinking outside the box a little bit, or I made my box bigger and thought, oh, I could use this as a way of selling stock I wanted to sell anyway, or, I could use this in different ways, then this strategy became much more appealing. So, what are the benefits is that I can make some money by I'm being paid a credit. So I'm generating some income, while something may be going sideways, or maybe it's pulling back. And so that's, a way to generate some income. It's also, some might use this because it's creating limited protection. And by that, so let's say earnings is coming up. And so you're here and earnings is coming up here, and you're saying, I think this thing is going to really, continue to go up, but what if it doesn't? And so you sell a call here, and then you might use the call you sold to fund the buying of a put down here. That's called a caller. We're going to talk about protective puts in another class. But it kind of, if it does end up pulling back, this call that you sold, let's say you got $4 for the call, you may end up buying it back for 40 cents. It didn't eradicate the loss, but it took some of the sting out of it. Okay, so this is what it means by limited protection. Okay, but it's limited to what you got paid, this $4. And it's often, a short to intermediate term strategy that you can do it, I like to call it a wash, rinse, repeat. You can do it again and again. But we are limiting our upside gains, and the shares can be assigned prior to expiration. So you can be called out at any time. The further it is in the money, so if, let's say, your stock, here's our strike, let's say this is at $40, and all of a sudden this thing gaps up to 50, your odds of being called out are much higher. Okay, and your downside protection is limited, to the premium that you got paid when you got in. Okay, so I'd like to cover some of these basics, but at the end of the day, if you want to just learn about something, you can take a course. The reason you come to a webcast like this is because we go out and we look at the charts. And so we're going to do that. And this is some of the additional things we may want to be looking for when we go in and look at the charts. Whoops, let me shake my Etch-a-Sketch here. We know that we have to be prepared to sell the stock, okay, at any time prior to expiration. We know that events like a dividend or an earnings announcement can impact the price of the stock. And we may want to consider this when volatility is higher, because when volatility is higher, our option premiums are higher and we'll be paid more. And then we've got to be aware of the fact that if we're called out, there can be, a tax consequence. And I don't talk about taxes here, but, if it's say a NVIDIA where you've made a really big return and you do end up called out, then, the government is going to come a knocking and saying, we'd like a piece of that. And how big a piece depends on how long you've held it and what type of account it's in and all that kind of stuff. Okay, so let's look, when we go out and look, what are we looking for? Well, we're looking for stocks that have been uptrending and maybe are now in a neutral or sideways trend. So, but ultimately we're bullish. We're looking for stocks that are getting close to a ceiling or at a resistance area, or that are bouncing off a resistance area. So they've come up and they're starting to pull back. We want stocks that have higher trading volumes. And why do we care about that? Well, because we want the options to have high trading volumes so that if we're selling a call, when we go to buy it back, that there's likely to still be somebody interested. Okay. Yeah, Roy has typed a comment into the chat saying paying taxes means you're making money. And, I've talked about this a lot. And, it's like my goal is to have to pay six figures in taxes on my trading. Like, wouldn't that be awesome? Because it means you're making a boatload of money. You know, and it just depends on what your account is. But, you know, a taxable event is not, you know, a bad news bear story. You know, so yeah, it's not necessarily a bad thing. And every time I get on a road here, you know, the roads in Utah are fantastic. If there's a fire station down the road to help me out if I need it. So, you know, it all works out. Okay. So I'm going to get off that little tirade. Okay. So, but we want options, you know, that have open interest. Open interest is the number of contracts that were on the books when the market opened. And we want options that have a tight, what they call bid-ask spread. So the difference between the bid and the ask is less than 10%. Okay. So let's get out to the charts. And because we're talking about stocks that we already have, I've come to this account where I've put a boatload of money in here. And sorry. Okay. We've got a bunch of different stocks. And I looked at these. So there were stocks for growth, stocks that paid a dividend. You know, we've got all kinds of stuff in here. But I wanted to point out too, you know, and some of these have done really well. Like look at Spotify, it's up 62%. But we have a couple that have been on the struggle bus. And one of them is Chubb. And another one, actually, Amazon, we're up 18%. But we've been in that one for a while. So we're going to look at Amazon and we're going to look at Chubb, ticker symbol CB. So with Chubb, we bought this one back in September. And when we kind of look at why we bought it, it was like we had this cup and handle pattern that had set up. It had broken out. So we added this one to our portfolio. And what's it done since? It's kind of gone into this sideways pattern. And, you know, and we're not up a whole lot on Chubb. It does pay a dividend. So, you know, but it pays a dividend of 1.2%. We're up $359, only 1%. You know, and so we might say, well, you know what? I know that the financial sector has been really strong, but, you know, maybe, you know, I might not mind selling Chubb, especially if I don't have a lot of cash to invest left to invest in my account. Maybe there's another stock I might rather invest in. And if I sell a call and have somebody pay me to sell the stock, you know, might that be a way of exiting this position? So it's currently sitting at 287. You know, could we sell the 290? And often you'll come out saying that 20 to 50 day range. But if I sell the 290 here, I'm only in it for 17 days and I'm getting paid 330 to 370. Now I could commit to 45 days, another, you know, 30 days, almost another 28 days, and I'd get paid 680. You know, or I could come out here to this January 17th and I could sell the 295 and get 430 and say, you know what, if I end up selling this for 295, that's $7 a share, more or less, $7.30 a share, more than what it's trading at now. And I get paid 430 to 470 to sell it. Am I okay with that? And if your answer is yes, then away you go. Now, this is a pretty expensive stock. Today, it's only traded 300,000 shares. But when we look at open interest, do we have a lot of contracts at this 295 or at the 300? Well, we have hundreds of contracts. And this probability of in the money is saying, you know, we have a 35% chance of this being in the money at expiration, but we have a 69% chance of it coming up and kissing it or trading above it. You know, so, if we're saying, well, I wouldn't mind selling it. Now, if you want to sell it faster, you might come to the December 20th. And we're saying, if we sell it, great. If we end up not selling it, we're okay with that too. Okay, so if we look at this 295, we're looking to sell, and we're just going to sell a single contract because we only have 100 shares of the stock. So we're going to come to confirm and send. Let's see if we can get, 430 for this. And we're going to put this in our covered call group. Now, Chubb, I think this is going to say this is illegal. Now, why is it saying that? Well, it's saying that because we have a stop in place. So we are going to come back to our monitor tab, and we're going to come to our working orders and see we have this exit in place. We're going to cancel that. So now we don't have a stop on Chubb. So when we come to our trade tab, confirm and send, that whole illegal thing is gone, because we wouldn't want to have it hit our exit and sell the stock. And now we have sold that would be called a naked call, and we'd have unlimited risk. So we're going to put this in our covered call group. And that's filled. Well, now when we come and we look at our covered calls, we have the call, but we don't have the stock. So we're going to come over here to Chubb, and we are going to move this up to the covered call group, so that when we come and we look at this, we can see that we have both positions. Now, if we want to protect ourselves to the downside, otherwise, how much are we risking? Well, technically, I'm going to click this little sprocket. We're going to add net liquidating value. Why didn't that? Okay. Oh, they've changed the format on this. Net lick, add. And we're going to add profit and loss percentage. Add that. So we can customize these however we like. So, what we're risking is $28,000 if we don't have a stop on this, because technically it could go to zero. So if we look at Chubb and say, well, it's been kind of going in this sideways range, maybe I'd put my stop somewhere below this recent low here of 275.66. So if I went 2% below that, 275.66 times 0.97. So we're going to put our stop at 267.39. And you might say, well, how do I do that? Because I have this covered call. We're going to highlight the whole thing, right click, and create a closing order to sell, to both buy the callback and sell the stock at the same time. Okay, and we don't know quite what the call will be worth, so we're going to make it a market order, and we're going to click on this disappearing, reappearing sprocket. Okay. Now, where did that go? Oh, no. Oh, here it is. So we're going to say, hey, if Chubb goes below 267, 267.39, we would like to exit this position. And so when we come to confirm and send, it's going to say, okay, we want to sell this at the market if Chubb, only if Chubb goes below 267.39. Okay. And we will both be buying back the call that we sold. So that's kind of one of those things of it's not going to eradicate the loss, but it might take some of the sting out of it because we got paid over $4 for that call that we bought. Okay. Okay. So are there any questions on that? Okay. Let's look at another one. And the one I wanted to look at was Amazon. And if you want to draw this on your chart, we did the 295. So I've just drawn a line. You can edit it. And then you can type out covered call or just say covered call. It's the 295 will show up and it's the January expiration. And then we're going to make this value 295. And I have my default set that the price will always show up on the right. And then I'm going to come here to show name. And this is the name I've typed in. So I can see now that I've sold a covered call that expires in January. So when I come and look at this position, if it's above this line, then chances are, I'll be called out at expiration, if not before. Now, if at expiration, it's at 295.50, it will, with few exceptions, it will automatically exercise and your position will be sold. But if it's just barely in the money and you decide that you don't want to sell it, then you have choices. You could buy it back and chances are it would be worth, if it was trading at 295.50, chances are that option will be worth less than $1. And you were paid over $4 when you entered the trade. How do we know that? Well, it says right here, we got paid $4.45 for it. Okay. Okay. So the other one I wanted to look at was Amazon. Now with Amazon, we're up 19%. So why might we want to consider that? Well, we might not. You might say, well, I really like this company. I believe in them fundamentally, whatever it may be. But Amazon is getting pretty close to, at an all-time high here. And so could we look at this and we had this pattern of consolidation, this kind of cup and handle pattern where it then broke out, came back to retest. It's moving on up, but it's getting close to this previous high. It's at 212. The previous high was, 215. So could we sell a call maybe around 220? And if we end up selling, are we okay with that? We are. And if you're not, then you don't sell the covered call. But could we do something and say, hey, you know what? Could I just come out even 2 weeks and say, what are the odds of it moving up above 220 in the next 17 days? Well, and do we have enough volume here? Well, 13 million contracts traded, so check. Okay, just a sec. Let me grab my drawing tool again. I think it's the French Canadian in me. Can I really talk without having some kind of drawing tool in my hand? I don't know. But, we've got over 13 million shares. When we look at, so this is really on the short time frame. But if we look at this and we say, we've got thousands of contracts here on open interest. We have hundreds or thousands of contracts that have traded on this just today. And if you say, well, if I just came out to this 220, I'd get paid $2. So that's like 1%. I'd be in this for 17 days. And the odds are, the probability of it being in the money at expiration, 27%, but the probability of it at least kissing it or touching it, 53.6%. So we could end up having to sell, but we'd be selling, at $8 above where it's currently trading, or close to it, $7.50, and we'd be paid another $2. Now, could it go up to 225? It could, You know, what are the odds of it being at 225 on December 20th? About 15%, about a 30% chance of it touching it. So if you want the probability to be higher of it expiring worthless, you're going to receive less premium. The further out you go, the less you receive, but the higher probability that it will expire worthless. Okay. So we are going to come in here and we are going to sell the 220 expiring December 20th. Just as an example. And we'll look at these, you know, next week, because we'll be talking about buy right covered calls next week. So we're going to come here, we're just going to sell, and we're selling a single because we have just 100 shares of Amazon. So we're selling this call, it expires December 20th. We do not have a stop on this position. You know, and this doesn't recognize that we already have 100 shares. It's saying, oh, you aren't buying 100 shares, so your loss is infinite, because they're seeing this as a naked call. But in fact, we have 100 shares of stock. So, you know, our potential loss isn't infinite, but our max profit on this is $206. Which program am I using? This is the Thinkorswim desktop platform. Okay, so we're going to send that in. We're putting it in the covered call group, and then we're going to come down here to Amazon, and we are going to move that to the covered call group. And then once that fills, let's come back to our working orders. Oh, it's now saying they only want to give us $2.03. Okay. We just want this to fill. And if you wanted to put a stop on this, you'd go through the same process. So we have that filled. So let's come out and look at the charts again. Say, if we wanted to put a stop on this, where might we put a stop? Well, we might say, this 30-day moving average has been acting as a support level. So if I look at this 30-day moving average, it's currently sitting at 267 cents. So if I take 200 times 0.67, and let's say go 2% below that, our stop would be at 196.66. It's a lot of sixes going on. So we're going to come to our covered calls, and we're going to come to Amazon. You know, they say repetition is the mother of all learning. So, and again, we want to buy back the call if we exit this position, and then sell the stock. So if it goes below 196.66, the stock price, buy back that call at whatever it's currently trading, and sell the stock. Now, if the stock were to gap down, we could get out at a lower a price on the stock than we were expecting. So, but we at least have some type of exit in place. And fire in the hole. And it's saying, you know, you always want to read this. With stop orders, there is no guarantee. And we just talked about that. So now we have our stop in place. Now I just want to make sure I made both of these good till canceled. So there's Amazon, or sorry, I want to make sure I have both of these good till canceled. So on Chubb, this will expire at the end of the day. So if we were to come back and look at this tomorrow, there would be no exit. So we're going to cancel and replace this and just make this, we're going to leave it the same, but just make it good till canceled and put it back in our covered call bucket. So we just caught a mistake that we made. We as in me. Yeah. Okay. Have we got any other questions on this? And so kind of what we're looking at, you know, with Chubb is saying, yeah, we wouldn't mind selling and putting our investment into something that we think might perform a little better. With Amazon, our thought process might be, because we've sold this 220, it's like, I'm just looking to make some extra cash. I don't really want to sell. I know that that's a possibility, but I've made my strike high enough. I think it's December 20th. I've put my strike high enough that I think that the probabilities are low that it will end up above that, in the next few weeks. Yeah. And you know what? If it is, I've made some decent money. I'm okay with being called out. So that's the thinking behind it. And so if you want to practice this, if you have a paper money account like I do with a bunch of different stock positions in it, you could just practice this and see how it goes. And you can put a note in just practicing. If you end up selling it, it won't be called out ahead of time if it's in the money at expiration. And I can show you just quickly before we wrap up, we did one here on AAOI. And we sold the 40 call, it's already through that strike. And if it were in our live account and we were called out, we bought this net for $34.68. If we got called out at 40, we've made $5.42 a share on a $34 investment. 542 divided by 34.38. That's a 15.7% return. And so if we get called out, let's say tomorrow on this, we should not be crying in our cups and calling our friends and going, oh, you won't believe what happened. I made 17% on a trade I was in for 2 weeks. Yeah, no, we agreed. We'd be doing the happy dance. It's like, yay, we got our cash back. We made our max gain. And we're okay with that because we placed this trade with the goal of being called out on this particular stock. And we're going to talk more about this strategy next week. We bought it here and we put the call here and we knew we might be called out. That was kind of the goal. So you can use covered calls for, different reasons. GV is asking what the purpose of the ATR indicator is. I usually leave this on because in my trading a smaller account, we'll sometimes do a trade and we'll do something like buy a call and say in an average day over the last 14 days, AAOI moves about $3.15. So we're going to buy a call and we want to exit when it goes up $3.15. It just gives us a sense of how much the stock moves. So average true range tells us the amount the stock tends to move from the high to the low of the day over a period of time. And the period of time we're using is 14 days. So that's the use of that indicator. It doesn't really apply so much for covered calls, but it's just another tool. Okay, so let's go back to our PowerPoint and wrap things up. So when are we going to exit? Well, we could buy back the call if it's lost a certain amount of its value. And remember, we talked about if something's going sideways, we might just decide to buy it back. If we sell at resistance and then it comes down, so we place the trade here, we may say, hey, when it comes down here and bounces, it may have lost half or 3/4 of its value. We'll buy it back here. And then we'll sell another one when it comes up and starts to roll over here with the goal of buying it back. So you buy to close. Maybe you might say, hey, if it's lost 50% of its value, so I've got 50% of my max gain or 80% or 90%, I'm going to buy it back. You may get close to expiration, like the one on Amazon, and say, hey, this, we sold the, what was it? The 220 strike. It's now trading at 218, but tomorrow's expiration, so it's only worth a pittance. I'm going to buy it back. So I'm going to buy back the one that, expires in December and then sell the January. That's called rolling it. And it's simply buying it back and then selling one at another expiration. And we might say, hey, this time we're going to buy back the 220. And I don't remember exactly what the numbers were. And now I'm going to sell the 225. Doesn't mean you're selling the same one. You could sell one that's further out. You could say like, hey, if this goes into expiration, it's so far in the money, I'm going to be assigned, but I'm going to make my max gain that I was anticipating, and I'm okay with that. So, if it's in the money, even by 50 cents at expiration or even by a penny, it's likely that you will be called out and you will end up not losing the shares, you're selling the shares. Okay. And if you no longer want to own the stock, you can buy it back, buy back the call, and then sell the stock. So you've got lots of choices. I was going to say options, but that can be confusing when we're talking about options. Okay. So I think we've done what we set out to do here. We've defined a covered call. We've looked at some of the considerations. We looked at some of the reasons why you might consider using a covered call. And then we've done 2 example trades on stocks that were currently in my example portfolio. And then we not only placed the trades, but we went back and said, and here's how we could add an exit or a stop to that position. And so we did that as well. Now, if you want to learn more about covered calls, you're thinking, I have a lot of stocks in my portfolio. This might be a good tool for me to become more familiar with. Mike Fairborn teaches a class at 2:00 Eastern on Mondays called Covered Calls and Short Puts. And so every week they're either talking covered calls or short puts or some combination thereof. So you may want to check that class out. And I hope you'll come back next week for kind of part 2 in our covered call series, where we'll be talking about buy right. So this is a 12-week series. Today we were talking covered calls. So, and if you're saying, oh, this is my first time here, I'd like to go back and listen to this, I will put a link in to the playlist at the end, in the recording, so you can go back and do some binge learning. But next week we're talking buy right covered calls, where we both buy the stock and sell the covered call at the same time. So this isn't the beginning. We're actually in week 4 of this 12-week series. And then we get to the things I wish I'd known when I started, and then we go back and we do it all again. And the idea here isn't that you become an expert at the end of 12 weeks, but that you have an idea. So if you have a really large account and you have a lot of money sitting in cash, you might say, what, this buy right strategy really looks interesting. I think I'm going to explore that. Or I really like the idea of these short puts. And someone else may say, like, hello, I have a $5,000 account. I can't afford to buy 100 shares of almost anything, but I love this idea of the long calls. Or I love the idea, given we're bullish right now, of these long call verticals, where I've got defined risk and defined reward, or these short put verticals. And so I'm going to go to the class that focuses on these, which happens to be taught by Mr. Ben Watson on Thursday mornings. So it's, short put verticals, so it just depends on what you want. So the idea is enough to know which strategy you want to master first. Okay. So here's the deal. There is a survey in the chat. And if you're with us live, there are 2 questions in this survey. So one, it goes from 1, which was, I hated this, I'm never coming back, to 10, I loved it, I'm now going to attend on a regular basis, and everything in between. You can also put a comment in. So let me know what you'd like to see more of or less of. My commitment to you is, if you fill it out, I will answer I will read each and every comment, and so will the management team. So you have a voice, and this is one of the ways that you can use it. If you'd hit the like button, that it's I like to say it's a way that you can do a favor for someone you may never meet by just moving this up in the YouTube algorithm so more people can find this content. So hit the like button. And then if you haven't subscribed to the channel, it's another free resource. Like, what are you waiting for? It's in the bottom right corner. Just hit subscribe, and then you can easily access all of this information. And last but not least, please follow Mr. Watson and I in the Land of X. Ben Watson, CS, Barb Armstrong, CS, Be There, Be Square. Up next is Mr. Watson with Trading Flag Patterns, and then I'll be back filling in for Cameron May in Getting Started with Technical Analysis, and I've got that thing all lined up. We're going to talk about trend reversal patterns, and there's a pile of them out there, so it'll be a fun class. So guys, take care, have an awesome day, and we'll see you in a webcast coming up soon. Bye for now.